Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets. Let's get started. This week, we are going to cover the most exciting story gripping all of the investment world, Gamestop. Now, if you haven't been doom scrolling Reddit or reading the front page of the Wall Street Journal, you might ask, what could possibly be exciting about a little retailer in every strip mall across America? Well, actually, this is a story of the Goliaths of Wall Street being taken down by an online network of little Davids. And in addition to being a story of Davids and Goliaths and the Davids winning, it's also a story about how crazy financial markets can be when the Federal Reserve is printing trillions and trillions of dollars. So before we talk about what's been happening, need to make sure you understand three basic things. You need to understand something about GameStop, something about an industry called the hedge fund industry, and a practice on Wall Street, and particularly among hedge funds, called shorting stocks. So, what is GameStop? Well, it's exactly what you think it is. It's the retailer in every strip mall across America where you go in and you buy video games and you buy the hardware to run those video games. Or, more commonly in recent years, it's where you don't go to buy any of those things because you buy it online and you download the games. And because that has been the headwind that GameStop has been facing in their core business, a lot of people on Wall Street have been very negative on their stock because, believe it or not, GameStop is a publicly traded company. So you can make bets on whether you think their stock is going to go up or go down. This is where hedge funds come into the story. Hedge funds, forget what the name might imply to you. It has nothing to do with your lawn. It has nothing to do with hedging, which is reducing risk. Hedge funds are what we would call the masters of the investing universe. These are investment firms that you have to be rich to invest with them. You have to be a so-called accredited investor, which means you've got enough money and enough sophistication to invest with people who are going to potentially put on very sophisticated and very risky strategies with your money. And hedge funds, if Tom Wolfe were to update his novel to current times, the masters of the universe would be the hedge fund managers. They make the most money, they drive the fastest cars, they fly the private jets. All right, you got a picture of who they are. And then there is short selling. And this can be complicated to think about and understand, but it's pretty easy conceptually. If a hedge fund believes that a company is in trouble and they want to bet that that stock is going to go down, then they sell short that stock. All right? And now if you think back, there was a movie a few years ago called The Big Short, where people tried to bet on the price of housing going down. All right, so shorting is it's been a common practice on Wall Street since the invention of financial instruments. And basically, there are lots of ways you can do it, but the most common way is you borrow a stock from someone who owns it. And then you sell a stock that you don't actually own. You have to give it back to that person at some point. And why do you do that? Well, if you sell it at 100 and it goes down to 50, you can buy it back at 50, give it back to the person you borrowed it from, and you made 50 bucks. All right? Sounds great. Unless, of course, if you borrow a stock, sell it short at 100, and it goes to 150, then you lose $50. So that's the bet that you make when you sell short. And by the way, this is such a ubiquitous practice. You've probably heard terms like don't sell me short, don't sell America short, all that comes from Wall Street. All of that comes from this practice of betting that a company may be in trouble and you think its stock is going to go down. So, because of the problems that GameStop's business has had in recent years, there are a lot of hedge funds that were making bets against their stock. and the stock was going down and going down, and the hedge funds were making money, and everything seemed to be right with the world. But a bunch of retail investors, probably lured into financial markets through some of the new online trading platforms that kind of make trading stocks feel almost like a video game. And just as when they network as they play different video games, they're networked in some of their stock trading strategies. And what these little retail investors using these video game type trading tools figured out is that the hedge fund industry had sold more shares of GameStop than were actually outstanding. And some bright spark said, wait a minute, if we start buying GameStop and the price starts going up, well, there's an automatic mechanism to force the hedge funds to buy GameStop too. Because if you are short a stock and that stock goes up, the regulators are going to make you come in and buy back some of the shares that you sold. So some of these online traders, these probably mostly kids, figured out that if we could get GameStop going up in price, then not only would we be buying it, but the hedge funds would have to start buying it against their own best interest. They would have to help the stock go up because their short position was going against them, and they would be forced by regulators to buy back some of the GameStop stock. And lo and behold, this worked better than anyone could have possibly conceived. And GameStop went up 50%, then 100%, then 150%, then 200%. Just massive, massive gains in a stock from a company that couldn't possibly be worth this. It was all basically what's called a short squeeze, when people who have sold a stock get caught wrong-footed and have to buy it back frantically. This morning, when GameStop opened for business, they're trading in their shares opened for business, the company was being valued at $24 billion. It's an absolute fantasy. There's absolutely no way that that company is worth remotely anything like that. And as we're now recording this, it's down about 50%. But guess what? That still makes it supposedly worth $12 billion, and it's nowhere near worth $12 billion. That's one takeaway from this episode, is that when there's so much printed money sloshing around in the marketplace, if it finds a place to start buying, it can push things to absolutely ridiculous limits. That's one lesson from this. The other lesson from this is the tremendous shift in power that is happening on Wall Street. 10 years ago, it would be inconceivable that the giant hedge funds, with all their sophistication, all their money, all their computers, it is inconceivable that a bunch of kids playing an online trading game could cost them literally billions and billions of dollars. And frankly, there will be some hedge funds that will not survive this encounter with a bunch of kids with a trading app.
Inconceivable!
This is probably going to be a permanent change in the power structure on Wall Street. And it could mean big things in how investment strategies are implemented. And Goliath will never, ever, ever again underestimate David. Now, one other thing that you may be worried about, because we mentioned the last time people tried to short something, it was the housing industry. When it blew up, it brought down a lot of banks. It brought down the entire economy. Could GameStop be that little spark that blows up the entire economy? And the answer is incredibly unlikely. Because in this instance, one, since 2008, there's been a lot of regulations on how much banks can lend to hedge funds. And it was the banks getting in trouble that caused the economy to get in trouble. So there have been a lot of protections to separate the hedge fund industry from the banking industry. And Fed Chairman Powell was testifying today, look guys, we're on top of this. There's not going to be a bank fails because there are going to be a bunch of hedge funds fail. All right. What will probably be an outgrowth of this is that money will move from this highly speculative, there's 23 billion, now 12 billion in GameStop. It can't stay there. It's going to flow somewhere else. Just like Tesla disappointed in earnings and it went crazy, and people will now start waking up to the fact that maybe Tesla can't, the earnings expectations are so high, maybe they can't all be met. You'll start seeing this huge slosh of money that's being in highly speculative places like Bitcoin and GameStop and Tesla. As it comes out of those places, it won't disappear. It will go into more mainstream places, like possibly Apple, which just reported more than 100 billion in quarterly income. So is Apple cheap? No. But will money go from the insane to the very pricey? That's probably going to be one of the consequences of the inevitable end of the GameStop speculation. Thanks for joining us for Market Insights. We hope you found it informative. If you'd like more of our research, you can go on our website, caravelconcepts.com, or you can subscribe at the link below. Thanks.